Welcome back. The world's largest cryptocurrency, Bitcoin, continues its downward spiral for the eighth straight day. It briefly fell below $21,000 and is currently hovering around its December 2020 lows. Other digital coins also sharply lower in that sell-off as investors continue to rotate out of risky assets due to the economic headwinds. Bitcoin started the week with a 15% drop, with Ethereum faring even worse, and overall, the total crypto market cap shrank to below $1 trillion for the first time since 2021. That's from a $3 trillion peak in November. Now, adding to crypto's litany of pain, Coinbase has announced it will cut nearly a fifth of its workforce, or about 1,000 employees, by the end of the second quarter. CEO Brian Armstrong said the company needs to manage high employee costs in an uncertain market, warning of a looming recession and another crypto winter in the months ahead. He also conceded that the company grew too quickly. Inflation pressures continue to mount in the United States. The annual producer price index rose 10.8% in May, staying near its record high of 11.5% in March. The data is significant as prices at the wholesale level feed through consumer prices, which are running at their highest levels since December 1981. Now, the focus shifts to the Federal Reserve as it kicks off its two-day policy meeting. The Fed is set to hand down its latest decision tomorrow morning with a 75 basis point move on the table. Investors on Wall Street are now waiting to see what the U.S. Central Bank will do. Stocks seesawed throughout the session ahead of that Fed meeting. It hit session lows during the final hour of trade, with both the Dow and the S&P 500 losing ground. The Nasdaq, though, posted a small gain. As equities closed mixed, we saw the yield on U.S. Treasuries continue to surge. The anticipation of an aggressive move from the Fed saw the yields on the U.S. 2-year rise and the benchmark 10-year rise higher again. And for more on this, we're joined by Tony Nash. He's founder and CEO of Complete Intelligence, joining us from Houston, Texas. Thanks for your time today, Tony. Now, 75 basis points of a hike is on the table. What does that mean for the U.S. economy, if indeed that is what we get from the Federal Reserve?
Right. It means they're really trying to pull back inflation. I think they're trying to kill demand so that the supply side issues in inflation are calmed a bit. Whether they hike 50 or 75 or 100 is less of an issue than the fact that it's really hard for them to control the supply side inflation that we're seeing right now with petrol and with oil and with food and other things. So what's happening right now that's really problematic is Americans for the past 2 months, if you look at consumer credit, it's really risen dramatically over the past 2 months. And that's when a lot of the petrol prices have really spiked. So people don't have the spare capacity in their monthly savings to pay for higher prices for petrol and food and other things. So consumer credit is racking up really quickly.
Yeah, and does that mean, Tony, that the strength of the consumers in the U.S. will start to inch lower? Because for a while, it was really this consumer spending that was trying to keep the economy going.
Yeah, absolutely. And as that, say, consumer credit capacity is limited, you're right. It doesn't, if interest rates rise, it makes it harder for those people to pay it off, right? So that credit capacity can't be paid down. And, economic growth, consumer-driven economic growth later in the year is harder to see take off. So this summer, people are paying more in the U.S. for gasoline and flights, and really people want to take a vacation no matter what. But I think we're really going to see some pressure on consumers in, say, September, October. So if they hike 75 at this meeting, it just means that in 2, 3, 6 months, as they accumulate the future Fed rate rises in July and September and November, it means that the cost of credit 6 months out is going to be dramatically higher.
Before this week, Tony, It was 50 basis points. That was what was expected after the inflation data that we got last week. All of a sudden, we're getting expectations of higher interest rate rises. Does this surprise you that it seems like the U.S. Central Bank keeps getting surprised but how inflation is ticking higher and it's not turning the corner as some had expected? And what does this mean for their credibility?
Yeah, it's a good question. Am I surprised that they're surprised? I'm shocked that they're surprised, right? And I think what it does is it creates, as you say, a credibility issue both for the Fed and for the U.S. administration. So the U.S. administration isn't putting the right policies in place to help the supply side inflation issues at refineries with crude oil, with food, and so on and so forth. But the Fed is late. The Fed should have started hiking months before they did. So many people have said this, but the Fed is late, and now they're having to catch up super quickly, and it's going to hurt people kind of on hourly wage jobs and in kind of the lower middle class. Those are the people who are the most constrained, and those are the people who are going to hurt the most.
Yeah, they're trying to play catch up, but does this force the hand of the U.S. Central Bank to actually push through with a 75 basis point hike when that's pretty much what most people are expecting?
Yeah, well, a lot of the banks are over the past couple of days have started to expect 75. Some are still at 50. I wouldn't be surprised if they stayed with 50. If we saw that, we would see markets rally going into the weekend, which might be a nice sentiment break for people. If they raise 75, then markets are still going to be very difficult and very choppy going into the weekend. So, it really all depends, the decision tomorrow. But I think it also makes things more difficult in Asia and other markets. If they continue to hike, then the dollar grinds higher. And it makes things like oil and other commodities that much more expensive as those dollar denominated commodities become more and more expensive for everyone around the world.
Yeah, and that would just exacerbate the inflation pressures that we are seeing right now. Thanks so much for your insights, Tony. Tony Nash, their founder and CEO of Complete
Thank
Intelligence.
you, sir.